Imagine if you had the opportunity to invest in a company like Apple or Google before they went public back in the day. Your initial investment would be worth significantly more now than what it was worth up front, and it may have even potentially put you in a position to be able to retire. Welcome back to my channel. My name is Reese, and in today's video, I'm giving a bit of a background on what an IPO is, also known as an initial public offering, and what to look out for in the instance where an opportunity arises so you don't let it slip through your fingers. When a private company wants to raise funds to develop and grow, they give hungry investors the opportunity to buy shares and stock in their company by going public. But before the company's shares begin trading on a regular stock exchange, such as the ASX or the Dow Jones or the New York Stock Exchange, for anyone and everyone to buy, the companies will offer investors an opportunity to buy a specific set number of shares for a specific set price in what is known as an initial public offering or an IPO. There is usually a catch with IPOs, and that is that generally companies will set the number of shares that you must buy. So there's a minimum threshold that you must purchase in order to be involved in the transaction. For big players, it's not too much of an issue, but for small people like myself, who don't have hundreds of thousands, if not millions of dollars to play with, it may potentially be something that kind of exiles you out from that opportunity. Now, the reason why this can be good is because the company needs to disclose all the information about the initial public offering. So they're not saying, hey, buy some shares and we'll work out a price, and there's no bullshit around that aspect of the deal. You have all the information about what they are offering for you to get involved in. You'll have the set price of the shares, how much you need to buy, when you need to buy them, by how you're going to buy them, all of the information that's relevant, which is good because it creates transparency between you and the company. One thing to definitely be cautious of though is a company gets to set this price of the shares that you're going to buy. Now, they could just throw any number in there, and if you look into it and you say, okay, that's pretty high for a share price for a company of this stature, I don't know if they're going to have the opportunity to grow and actually build a company that is going to increase that share price over time, making it technically a bad investment for yourself. So something to be cautious about is they set the price. You need to do your own due diligence and understand if that price is what you would deem to be fair or competitive in the aspect of them eventually going public, and then people going, oh, that's a good share price, I'm going to invest in that company. So coming out of this, the key points are, what are the company's long-term growth prospects? So are they a company that is going to do really well in hard times? Are they a company that are providing a service for people during hard times? Are they a company that should absolutely boom when economies boom? Or are they the type of company that's going to get shut down because of a lockdown in the country that you're in? That's number one. And number two is, how much money are they planning to raise from this IPO? It should be pretty clear based on the stats that they give you. And ultimately, are they basically just raising a shit ton of capital that is not going to actually give them any opportunity to do anything with? Or are they raising money for a specific purpose to build new factories in specific countries that are asking for this solution that they are planning to implement? So once the company has all of the investors' applications of the people who want to get involved with this, the company then goes through some type of screening process known as book building. A book build is the process through which a company generates, captures, and records investors' demand when raising capital. The intention of this is to achieve the best price in the sale of the shares. The purpose of the book build is to determine the exact price that the shares will be worth the day they hit a stock exchange. And this is important to understand as well, because it will give you a pretty clear indication of what they're going to be listing the shares on the stock exchange for. And then once the book build is complete, the shares do get listed on that stock exchange, ready for trading for anyone and everyone to buy stock in those companies. Now, there are risks when it comes to getting involved with a company who is offering investors an opportunity to participate. The main concern, kind of tying it back to what I was saying earlier, is the fact that the company gets to set the value of these shares. Now, they might be offering you something, and in their minds, they're saying, okay, you're going to be buying this at a discounted rate because this share price is just going to boom. It's going to take off. When in actual fact, it has no guarantee of going crazy. You could invest your money into this company and then it hits the share market and it goes down because no one wants to invest in that company. So just because you think it's a great idea doesn't necessarily mean it's going to be a great idea. And on top of that, it can be dangerous because the companies are the people setting the share price, basically making them the biggest risk taker here, because if the company flops and the value of those shares tanks, you're going to be in trouble. Another concern that's kind of out of your control is the fact that the company might not actually make money. They're raising all this capital and they're going public and it's great. But if their business model's crap, or their internal logistics processes suck and they just bleed cash, or the economy goes to shit and then they can't do anything about it, they can't run their company, they can't make a profit, the same thing. They will eventually bleed out all their money and then kind of default, become bankrupt and probably close down. Is it common? Actually, more than you might think. Lots of businesses, like I think there's a statistic out there, I'm not even going to look it up, I'm just going to talk off the top of my head. There's a saying, and it's for every one business that succeeds, 99 failed. And yeah, sure, if you're going to be listed on a stock exchange, it's probably not the most common of scenarios, but there are companies that definitely have fallen into this category, and it's something to be wary of nonetheless. And the final concern that I'm going to list today is the fact that the company that is raising capital through you, the IPO investor, may not actually pay you dividends, meaning the only guarantee of you making money from this investment is the share price going up. This is common practice with lots of newly established companies because their focus and their goal is to get as much money on board and then make as much money as possible to then explode and invest and grow their company to the point that it's a fully functional company that is just on the map. It's making money and they are in a position to then pay dividends to their investors. So there's no guarantee that you're going to make money in the form of a dividend payment or an interest repayment, which is a risk as well, because again, all you're really riding on is the fact that you want the share price to rise. So why is it important to understand what an IPO is? Well, realistically, you are a human being and you're someone who definitely might be in the opportunity space to get involved in one of these IPOs in the future. As a person who has access to the World Wide Web, you can literally Google companies and you might come across one who is going to fall into this category in the near future. Ultimately, having this knowledge and understanding what it is gives you the power to say, okay, I know what this is. I know what they're planning to do. I want to get involved. How do I get involved? And you can take steps from there, because if a company comes along that you truly believe in, something that you definitely want to get into, and something that you think will definitely make you a return, it could be an investment that basically changes your life forever. So it's something to think about, and it's absolutely something worth understanding. Hopefully now you're a little bit more educated and equipped for an opportunity like this. No matter what your age, keep your eyes open because you never know when an opportunity might present itself. Overall, I hope you enjoyed today's video. I hope that it was insightful, and I hope you learned something new. If you did, please consider liking and subscribing. It really helps the channel out. And as always, I will see you in the next one.